So I think, Don, one of the things you're asking of Chris is to say, how do you reallocate your portfolio so you don't get hurt by this coming rate increase?
Yeah, let me do a quick explanation. So you buy a $100,000 bond today, and that $100,000 bond lasts for 30 years. And they're going to pay you 2% on your money for the next 30 years. Sounds safe, right? As long as you hold it that 30 years, you're going to get your $100,000 back at the end of the 30-year period. But what happens if that 2% interest rate jumps up to 5%, okay? And then 2 or 3 years from now, you want to sell that bond. You want to get out of it. Well, if somebody can come to me and buy a bond paying 5%, why would they want your 2%? Okay, so the only way you're going to be able to sell that 2% bond back to the market is to sell it for less than the $100,000 that you paid for it. You're going to have to give something so that the purchaser basically is getting that bond at a 5% interest rate. So there's math that will figure that out for you and calculate that for you, but that roughly you're going to take a loss on it in order to get out of it. So that's how rising interest rates hurt bond portfolios. And if you're in a portfolio of like a mutual fund portfolio of bonds, it happens immediately. The bonds get revalued on a daily basis, and you see your mutual fund price start to drop based on the value of those bonds within the portfolio. So the first thing to know is that longer term is more dangerous. If I own a bond that only lasts 2 years, I'm not as concerned about where interest rates go because I'll just hold it to the end of my 2 years, let it mature, and I get my money back. But when you're holding long-term bonds, the movement of the price of that bond is going to be much more significant when you have a rise in interest rates. So the first thing you want to do with your bond portfolios is move out of the longer end of the yield curve. Start shortening up, getting into shorter term positions. It doesn't mean you have to completely go out of bonds, but start looking at limited term, short term, fixed income. The other things that you can do is there's something called floating rate out there. Floating rate is like the float rate that the banks use. It's a variable rate, and it rises with interest rates. So pull some money out of those longer term fixed bonds, roll it over into some floating rate securities that will actually get better performance as interest rates rise, and you still have a fixed income investment in your portfolio, but one that's going to benefit from rising interest rates, not lose from rising interest rates.
I'm going to pause you right there because that's something I want to learn more about. So do you get paid a fixed margin over a certain index on those products?
You talking about the floating rate products?
Never heard of that before.
No, typically, I'm talking mostly about the exchange traded fund or a fixed or a mutual fund that's made up of a floating rate investment. So that interest rate that it's going to pay to you is just a variable interest rate that you're earning on the portfolio, and that variable interest rate is going to adjust with interest rates over time.
Okay, so another show, I definitely want to dig into that, but we don't have a lot of time for that. So if you just heard that and it piqued your interest like it did mine, Chris, how can they get a hold of you?
Yeah, Chris Ingram, I'm at 661-255-9555, extension 16, or you can email me at Ingram, which is CINGRAM at nextfinancial.com, nextfinancial.com.
That was really unique. I had to stop him there because
I love, Chris, how you express that you by working with a professional that understands what you were just talking about. I know it went over a lot of your heads out there, which is okay. That's why you hire Chris. Or you work with somebody like Chris, because a professional can go, okay, now you're concerned with interest rates going up, therefore your bond portfolio going down. What's cool is Chris goes, no. Now we put the money over here, and as rates go up, you earn money. That's where the smart people make money. It's not you out there trying to think that you have this all figured out. You might not even know that you can earn money as interest rates go down. All you're doing is watching your portfolio go down. Work with a professional. I promise you, you will make more money by working with a professional. There's a reason we're all out here, is to help you and guide you in the right direction.